Want to know how Canada's top entrepreneurs think about creating significant wealth? Join me, Thane Stenner, founder of Stenner Wealth Partners at CG Wealth Management and host of the Smart Wealth Podcast. Download today at iHeartRadio or your favorite podcast platform. Subscribe now.
Hello, everybody. My name is Thane Stenner of Stenner Wealth Partners of CG Wealth Management. I'm also your host of this BNN Bloomberg Smart Wealth Podcast, where I get to interview various guests from around the world on various relating topics pertaining to investments and entrepreneurship. So I have a very special guest, actually a third-time three-peat, David Rosenberg. Welcome, David.
Great to be back. You told me, Thane, that you're going to continue to have me on until I get it right. So something tells me we're not going to be stopping at 3.
No, I agreed, but I've known you long enough, David, in the last 25 years that since our Merrill Lynch days, that I do know that you have been way more right than wrong in your career, my friend. So I'm really looking forward to today's update, actually. And in fact, I'll just give a little bit of bio or background. David and I both worked together in different capacities at Merrill Lynch. Probably 20, 25 years ago. And I've followed David's research and prognostications and forecasts for many, many years now. And I hold him in high regard. And I'd have to say, from a global point of view, he's probably one of the most followed and respected economists and investment strategists there is out there today. So again, David, I know you're super busy these days, but thank you once again for making it out. I'll give everybody a little bit more of David's bio. He's the founder and president of Rosenberg Research, an economic and financial market consulting firm that he established in January of 2020. So he provides advice through his research, of which, by the way, full disclosure, we're also a paying subscriber to his excellent research, to about 2,600 clients globally, both retail and institutional, across 40 countries. So David's views and his team's views are very widely followed on a global basis. Prior to creating his own company, David was also the chief chief economist and strategist at Gluskin Sheff and Associates from 2009 to 2019, roughly 10 years. And prior to that, from 2000 to 2009, he was at Merrill Lynch, where the first 2 years he was chief Canadian economist, as he's a fellow Canadian, for those of you listening in, and strategist based out of Toronto. And for the last 7 years of his career at Merrill Lynch, basically, he was the chief North American economist at Merrill Lynch, Hastings, New York, where he was consistently ranked in the top 3 of all Wall Street economists, polled by the annual Institutional Investor Survey. He's also a very frequent contributor to most major financial newspapers, publications. You probably see him regularly on CNBC and BNN Bloomberg and lots of other publications on a global basis. This is the way he gets his words of wisdom out. And, as they say in the forecasting business, it's like eating crushed glass at times. It's never easy to get it all right. But I can just tell you from what I've heard over the years, he's been way more right than wrong, which in this business is a tough thing to do. He's got a BA and MA in economics from the University of Toronto, which is, I think, originally where he's from. Is that correct, David? You're originally from Toronto?
Well, born and raised in Ottawa.
Oh,
Moved to Toronto in 1979.
Oh, interesting. Well, I learned something new today. Thanks for sharing. So I'm going to start off with a geopolitical question, if you don't mind, given the fact that it's December 9th today, 2024. I mean, we just had some interesting news, very interesting news with Assad in Syria. And I just want you to maybe, given the fact that it just hit the headlines yesterday, maybe just kind of comment as to what sort of impact that might have on the global markets, just from your point of view.
Well, what we don't know is what the final end game is going to be in Syria, and what Assad's downfall, which I think for the world is a good thing, but what the replacement is with an official terror organization, who knows what that's going to bring. Um, and it's opened up a vacuum, as we've already seen already in Syria. So look, it's hard to make book on what the final situation, stable government will be in Syria. So there's just a complete unknown. I think that we have to. This is the problem I always have with geopolitics staying as that. There's often just a little too much speculation, and people's gut reaction at the beginning isn't generally the right reaction you want to have as an investor. I'll just say that I would not want to invest around uh, the situation in Syria right now. I think that from a world perspective, the fact that this is a blow against Iran, and I would consider that to be a good thing. And it's a blow against Russia. And I would have to also say that that is also a good thing. I think that we will get probably a better feel for how things play out in the Middle East after Donald Trump actually takes over the reins in the third week of January. We'll get a better picture. But the answer to the question is, do you buy oil, not buy oil? I mean, that's always the knee jerk reaction. What do I do? Because oil is basically the poster child for how you would invest around um, geopolitical events.
Yeah, well
But
said.
there's other factors that I mean, if you actually thought that this is going to be something that's going to disrupt oil supply, that'd be one thing, which I don't think is going to happen.
Mm.
Um, Really, the most important thing for oil, if we're talking about geopolitics, because that's what people care about, is what does it do to the oil price? What OPEC Plus does in terms of its next meeting and whether or not they're going to go through at some point with higher production, what happens with the global economy in China. Like right now, if you're asking me about oil related to geopolitics, it's actually oil prices rallying today, mostly because of what happened in Beijing and the pledge for more monetary and fiscal stimulus. So the commodity sector in general is benefiting from that.
Yes.
And of course, what happens with drill baby drill and the fact we're going to get a lot more domestic energy production in the United States.
Yeah.
There's so many more things going on. Like I think if I was here as a geopolitical expert talking about the Middle East, we could talk about it a lot more. But I would say to people on the call who are investors, I would not be making what's happening in Syria right now, or really what's happening in the Middle East, as something that you would want to formulate an investment decision of. The only thing I would say as a caveat is what's happening globally in relation to the fact that we are several standard deviations away from anything normal from a geopolitical standpoint over and beyond Syria, which is that global military budgets, defense budgets are going up everywhere.
Yep.
And so I would say that the one area of the market that we've been very bullish on has been aerospace defense. So if
Mm.
you're looking for a hedge with visibility and not speculation, airspace defense has been and probably should remain a cornerstone of your equity portfolio.
Hmm. Excellent insight. So let's unpack 2024. Today's December 9th. The month and the year is not fully quite in the books yet, as they say. But what would you say this last year was your best one or two calls on the markets that you're kind of most pleased with?
Well, I'm most pleased of the fact that even though that I missed the uh, the multiple based, not earnings based, multiple based rally in the U.S. stock market, and I missed it, made up for it with bullish calls on Japan and India, which have been core to our global equity portfolio. And I'd say that I don't consider myself to be a market timer, but once we saw the Hang Seng Index, and that's really the poster child. I mean, we talk a lot about China, but Hong Kong was always basically, the central force for the emerging market uh, universe. And almost to the week, we picked the low in the Hang Seng. When the Hang Seng got to like an 8 multiple, we put a report saying, "Do you understand? This is the multiple that the U.S. market bottomed at in the summer of 1982."
Mm.
So I'm not proud of my U.S. call. If it was just based on earnings, the market would be up 8% this year. It wouldn't be up 28%.
Mhm.
So the multiple expansion has been absolutely incredible. But those other calls have been prescient. And we are, as you said, we're in 40 countries. We don't just bow down to the holy grail of the S&P 500, understanding that for
Yep.
some of our institutional investors, that's their stock and trade. Um, and it is unfortunate that something like three quarters of active fund managers have underperformed this year, which is reminiscent of what happened in the late 1990s when you have to hug an index that's become so highly concentrated. Another call that I'm proud of is although we got pasted in 2022 and into most of 2023, uh, I said that the inflation was transitory. And I never bought into the 1970s return to inflation. And I think in retrospect, 18 months in the overall annals of economic and financial history, 18 months was transitory.
Mm.
Now we're not yet at 2% on inflation. We're not at zero, but we've gone from 0 to 9 down to something close to 3. I think that's incredible progress. Maybe not enough for some over at the Fed, but tremendous progress. So we actually published a report in October 2023 at the 5% peak in the 10-year Treasury note yield. Now, that was a point. We got to 5%, and that was under a lot of pressure from clients and external sources to throw in the towel on the bond call. And instead, I put out a report that was called Bonds Have More Fun with a picture of Marilyn Monroe on the front cover.
Yeah, I
And I
remember.
know that you remember that one. And
Yeah.
it went viral. And look, through the peaks and valleys, we got down to 360, then we got to 450, now we're back down to 415, 420. It's not a straight line. But I felt that after being whacked around on the bond call for a couple of years, that we got it right, at least over the course of the past 14 months. So that was another call I can point to that I don't usually give myself a pat in the back, and I never will take victory laps. But that was a call we can look back on that it took a lot of courage and discipline to not throw in the towel on the bond call. And I'm sure glad that I didn't.
Well, actually, I think there's another call that you are understating, or because I think from what I recall, you also nailed some of the gold movement as well. So maybe just comment on that.
Yeah, so we wrote actually a seminal report on gold earlier this year. I've been bullish on gold for several years. Became more vocal this year, and you're right. That was another. It's because I've been. It wasn't a change in view, but you're right. The gold call really held us in good stead. You know, I'm accused of being some radical perma bear. I never told anybody that in our portfolio. I never said, "Hey, you know, we have canned goods, barbed wire, and sawed-off shotguns." Uh, we actually want to make clients money in a prudent way. And gold, I think gold's done better than the S&P 500 this year, and nobody even recognizes that. And it's happened in the context of a bull market in the U.S. dollar. So gold's been making highs in every currency term, which is telling you something about how gold's complex has been shifting from a commodity to a currency that is no country's liability. And
Well,
it's a ballast on the portfolio and a diversifier. But thanks for pointing that out. Look, there are other calls too. Look, we have, as you said, we're in 40 countries. 70% of our clients are in the States, 15% are in Canada, and the other, 15% are dispersed between Europe and Asia, some family offices in Latin America. We got our Canadian calls. You know, what's funny is that if we had gotten some of the US calls right, like we did in Canada, very bearish on the Canadian dollar. And I told people we're going to break into a 140, 150 rate on the Canadian dollar. People didn't believe it. It's there. When I said the Bank Canada was going to be singing like a canary and cutting rates aggressively without the Fed, that actually, of course, happened as well.
yeah.
We were calling for a US recession. Hasn't happened yet. Funny enough, the 51st state, or what you know, Donald Trump would like to have his 51st state, or so it seems. Stephen Poloz, the former governor of the Bank of Canada, actually came out and said Canada is in a recession
Yep.
just late last week.
Yeah.
So it's funny if Canada, Canada is 95% correlated with the US. So it's funny that Canada would be heading into a made in Canada recession and the US wouldn't be part of that. I haven't thrown in the towel on that call.
Where
But there were some other calls that we made. Unfortunately, the 70% of my client base in the US don't really care too much about Canada.
yeah,
But the Canadian calls this year, the Canadian calls, and especially the Canadian Government of Canada bond market is
Mm.
ripping on fire this year. And we were as bullish on the Canadian bond market as we're in the treasury market.
Mhm.
So for Americans that would be listening to what we were saying about Canada, because they can also invest in Canada, being in the Canadian bond market while shorting the Canadian dollar was a absolutely monumental trade this year.
we're going to take a quick break, so please stay with us, everybody.
Want to know how Canada's top entrepreneurs think about creating significant wealth? Join me, Thane Stenner, founder of Stenner Wealth Partners at CG Wealth Management and host of the Smart Wealth podcast. Download today at iHeartRadio or your favorite podcast platform. Subscribe now.
Thanks, everybody, for tuning back in. I'm here with David Rosenberg. So, pivoting now into the next year, and by the way, this podcast will be running on January 8th, 2025. It'll be our first podcast of the new year. Where do you think short-term rates, like, do you think in December, short-term rates in the US and Canada are likely to still come down? And by how much? I think the Canadian one is, of late is suggesting the possibility of a 50 basis point cut here in this week.
Right.
How would you read those tea leaves, David?
Well, I think that when you consider that the Bank of Canada, we'll talk about Canada first, that the Bank of Canada told us uh, last April that the Canadian economy had moved into a positive output gap, which is an economic energy term for saying that we moved into a state of excess supply, which is disinflationary. And that output gap has actually continued to widen. And the Canadian economy has continued to underperform, and inflation is coming down very quickly. And the economy and the unemployment rate's going up very quickly. Uh, I think in the name of consistency, where should the overnight rate in Canada be benchmarked against where the economy is and where it's going in the next year? Remember, the Bank of Canada told us this output gap is going to be with us into 2026. And so long as you have an output gap of any size, it puts downward pressure on inflation because you have supply running so far ahead of demand. I would be surprised if the policy rate in Canada goes to or below 2%
Hmm.
uh, in 2025.
Gotcha.
So I think they're coming, and I think in the United States, the short-term rate will be coming down as well. I think the swaps market's priced for 3.7 on the Fed funds rate. I think that will be at 3% or lower. And I think the Fed probably goes 25 basis points. They'll signal a pause. They'll take their dot plots from 4 cuts to 2 cuts. But I think by March they'll be back to 4 cuts. I don't think the easing cycle is over by a long shot. What I'm sensing in the United States that has me very bullish on the bond market. Believe the yield curve will steepen. I think that'll be good news for financials. Other reasons to be bullish on financials. I think that that's the one sector you can point to from Donald Trump and his policies that will be a winner. And it's already started to get priced in. But I think that what we're seeing, remember that 35% of the CPI is rent and OER. And we're getting to a crossover point where the old leases are vacating the CPI and the new leases, which have been deflating for the past year, are starting to dominate. Remember, the year over year trend in the rental components at the peak was 8%. We're
Wait,
now at 5.
wait.
But the real leases are running negative 0.6 year over year.
Mhm.
Can you imagine what, and this is not anybody's forecast, what happens with inflation when the year over year trend in the CPI rental components now of 5% plus converge on zero or below zero? That'll be the story for next year. I think people will be surprised because everybody's got inflation on the brain. Everybody's got inflation on the brain. God forbid you have a couple of months of disappointment and the whole disinflation story is over. It boggles the mind. Nothing moves in a straight line. I
Hmm.
think the surprise for next year in the United States will be how far inflation falls.
Mm.
And the Fed will be cutting rates. I don't think they'll have to go as low as Canada, but they'll be cutting rates far more than what the markets have priced in. Ergo, I am bullish on treasuries because there is not enough disinflation priced in, with or without a recession, and not enough Fed ease at this point priced in. Remember, at the maximum point of what the market had priced in for Fed easing, when was it? Back in September, the 10-year note got down to 360.
Yep.
I think we're going to go back and test that mark in the next 6 months.
Hmm.
So there's money to be made total return wise
Yeah.
in the treasury market.
And it sounds like being active too is probably something you're pointing to as well versus passively. Would that be fair?
I would say that 100%. And I think you have to pay attention to at all times.
Yes.
What are the sentiment levels? What's the market positioning? What's the valuation metrics? At all points in time, whether you're looking at the commodity market, the currency market, the bond market, the credit market, the stock market, you've always got to be cognizant of what do you think? What do you think is priced in? And that's the only way you can make an appropriate judgment. I didn't say a correct judgment because you only know if you're correct over the course of time.
Right.
But a well-educated, well-informed. You have to know what you think is priced in.
Yeah.
Are we
Well,
overpriced or underpriced or perfectly priced?
that reminds me of a Stan Druckenmiller quote where I know I'm sure you've met Stan many times over the years. But he quotes, he says, buying things today, prices kind of discount what's already kind of obvious today. And I think his main comment is you got to be trying to anticipate where things will be 12 to 18 months from now. So with that question or that comment in mind, where do you think it will be 12, 18 months from now? Say on the S&P 500 from where it is today.
Well, you know, I don't do that anymore. I don't that is a sell side. There's so many strategists out there that give you their targets. What do they mean? What do they mean? This time last year, the consensus forecast for the S&P 500 for the end of this year was 4,900.
Mm-hmm.
We're like almost to 6,100.
Yep.
And so now everybody, after getting it so wrong, are now at like 66, 6,700. Some are at 7,000.
Yep.
Uh, I care more about direction than getting a point estimate on the stock market. So I don't have a point estimate. Um, I have struggled with what's been happening in the U.S. market for some time. The markets continue to go up. I had similar difficulty back in '06 and '07, and I had difficulty back in 1998, 1999.
Yeah.
And I'm having difficulty right now, even as the market flies in my face.
Yeah.
Now, I wrote a report called The Lament of a Bear, where I tried to provide a rationale. The other side of the debate? I mean, the market is not filled with idiots. There's a lot of information. The market's telling you what it's thinking. Um, and so what I'm trying to find here is, what's changed without saying that it's necessarily different this time. But maybe we've had a model shift in the sense that AI is being viewed as a productivity and profit game changer, much like the internet was. Remember, the internet bull market became a major bull market, became a mania, then a bubble over a 5-year period before
Yep.
it burst in a spectacular fashion, as all bubbles do. And I guess I wrote my report saying, maybe if investors have lengthened their time horizons, maybe classic valuation metrics that tell us that we're in a bubble, maybe that's not telling the complete story, because if you've extended your time horizons because of an inflection point in the technology curve, a 1 year trailing, 1 year forward multiple is not going to take you very far. So try to understand. Comes back to what's priced in. Well, what's priced in, if you believe the market is appropriately valued today, you ipso facto have to believe that the AI wave is going to generate over the next 5 years 20% average annual earnings growth. That's the bet the market is made. And if you believe that AI, generative AI, and all the spin-off effects are going to generate 20% profit growth per year for the next 5 years, then this market is perfectly appropriate for you. But that is the assumption that's driving the market right now. Um, Having earnings that strong over a 5-year period historically is a 1 in 20 event. It's happened 5%. It's not impossible. But you're betting on a horse with 1 in 20 odds.
Gotcha.
And I just don't know. I just don't know. I think that there's a lot that we don't know about what the ultimate size of the AI market's going to be and how it's going to be regulated. I make no bones about the fact that in our professional and personal lives, it is going to be a game changer. Maybe call it internet light.
Mm.
But we've gone back and estimated what is the market telling us. That's more important than having a point estimate because I'll tell you right now, I've got a very low weighting uh, in the portfolio in the U.S. equity market. I have been 45% in the equity market, but a lot of that's been outside the US. And thankfully, knock on wood, in areas that have worked out almost as well. But everybody focuses on the beloved and ballyhooed S&P 500 because people believe that's the only stock market in the world. But we are global investors.
Mhm.
Um, but we have to assess, what does it mean when the equity risk premium is zero?
Yep.
What does that mean? What does it mean? Because it's happened and the market's telling you something very important. When
Mm.
the ERP is zero, when the earnings yield is the same as the treasury bill yield, when historically treasury bill yields are 300 to 400 basis points lower because you want to get compensated for being in a risky asset. But you see, the market is telling you, and for people that are continuing to invest in the S&P 500, what the market is telling you in terms of the level of the pricing is that it has become, in this AI cycle, a riskless asset. It's become a riskless asset. It's being priced the same as a riskless asset, a risky asset. So we've taken the capital asset pricing model and totally distorted it, if you know what I mean.
I do.
Basically, that the constituents of the S&P 500 have become, in aggregate, zero beta stocks. Now, if you believe that, then you want to buy this market. If you believe that the stock market has become a riskless asset class, uh, if you believe the only way that you would buy this market at these levels is if you believe that nobody will ever sell. You believe this market cannot go down, and you believe that nobody will ever sell their position. That's the only way this can be justified, but those are the assumptions. So I'm telling people those are the assumptions, and look what's happened the past 2 years, and the market has continued to go up. So there's a lot of believers that these assumptions are prescient.
Yeah.
I guess I'm a bit of a natural born skeptic. There's other parts of the world where you get paid to take on equity risk. And that's where I've been concentrating my attention on because I don't think, I'm not a buyer at these levels. I can understand why people who believe that, and like I said, there's a 1 in 20 chance they're going to be right, and a 1 in 20 chance, and you'll hit a home run. You see, I have not made my living by swinging for the fences. I've
Man.
had people complain to me that I missed out on the US bull market and I cost them a doubling of their wealth. Well, go to somebody else. That's not my style. You know
Mhm.
me 25 years. I've been in
Yep.
the business almost 40 years.
Yep.
Everybody knows that I am the purveyor of the thought of capital preservation. I was raised by Depression era parents who believed in thrift and hard work. I bunt for singles. And the odd time I'll hit a double, I don't swing for the fences
Mm.
because I don't want to strike out.
Yeah.
And this isn't a defense of David Rosenberg, but the reality is that I believe that losing money is worse than not making enough money. And I don't like losing people money. And the only time I've ever lost money in the asset mix was in 1987. Oh, I wonder why. But that's it. That's it. So I believe in the preservation of capital and I believe in the preservation of cash flows.
Hmm.
And I believe that diversification is not a dirty 15-letter word. So to answer your question, I don't know. I don't profess to know where the S&P 500 is going to be next year. I just know that I have strong conviction that we are long overdue for a correction. I'm waiting for a correction, not a bear market, but a correction. And then I'll make up my mind then as to how much money I'll put on the US market, depending on the circumstance. But you see, there are other opportunities in other asset classes
Yeah, like
and in other geographies. And so, the U.S. market is when you look. I mean, the price. I said before we shouldn't be looking at 1 year forward multiples, but the technology wave, like the internet wave, is going global. And when you look at the United States, the S&P trades at a 60%
premium.
premium multiple to the rest of the world.
Yep.
But I know, look, my heart goes out to people that have to invest in the United States and have to be a large cap investor.
Hmm.
But for people that actually have the flexibility, there are so many other compelling investment opportunities out there.
Yeah,
And that has been the case, by the way, as you mentioned, as you very generously brought up at the beginning of the show. There's other ways to make money uh, prudently without taking on that much risk. I will not invest in a market where I'm looking at a situation where the equity market is being treated as at a riskless asset. I
mm,
know that sounds crazy, but that is what is being priced in right now. And here's the deal: it has a lot of believers. It has a lot of believers, and you look at the ETF flows,
Hmm.
ETF equity flows. The ETF equity flows, Thane, it looks like Bitcoin.
I know.
I mean, we have a situation now where the ETFs, index investing, is now heading towards a 60% share of the overall market cap. When John Bogle first introduced,
Yeah,
the Vanguard,
value. Yep.
back in the mid 70s, he said this market will never get over a 20% share. It's getting up to 60%. So people, but what does that mean? Passive investing, passive.
Hmm.
And then, of course, these funds have to buy the market. The momentum and the fund flow uh,
Yep.
spirals together and creates the condition that we have right now. But people don't even know what they're buying. Ma and
Correct.
Pa Kettle have no idea what it is they own. And then the active investor with the CFA, and I guess a situation where maybe education doesn't matter anymore. Um, Active investing means that you look at balance sheets and you look at income statements and you
Mm,
do fundamental research.
Yep.
Passive, you don't have to do that. But the momentum trade is working spectacularly well, and then it just brings in more and more buyers until it doesn't. But that is actually the concentration risk in terms of 70% of the U.S. household balance sheet in terms of financial asset mixes and equities.
yep.
Unprecedented
Which
for
is
baby boomers like me and you.
yep.
Over 60%. We should be at 30 to 40. Okay, uh, from a demographic standpoint, time is not on our side like it used to be.
Yep.
They're at 60% plus equity exposure. I really, because the bull market's going to end, because the
At some
cycle is the
point, for sure.
cycle. I just don't know, because everybody is all in. Do you see what I'm talking about?
I
Everybody
do.
believes this to be the case, that the equity market has become a riskless asset class. Buy every dip, the market doesn't go down, or Donald Trump or the Fed will never let it go down. That's the mindset today. The stock market is a riskless asset. You can treat it like a treasury bill. And
Or
and that
or
that is and so right now, it's not just Ma and Pa Kettle, not just the general public.
it's
Professional equity fund managers Their
Mm.
cash ratio is 1.4%.
Yeah, all-time low.
1.4%.
Yep.
God forbid if we ever get redemptions, what's going to happen next? But, the thing is that I think that besides me, only Warren Buffett is sitting on any cash. Now, look, me and Warren Buffett, like you put me and Warren Buffett in a room together and take the average, and I'm a billionaire all of a sudden. So, but the thing is that the problem is going to be at the peak, whenever it happens. And maybe it's a conversation we'll have in 2026. I don't
Mhm.
know.
Mhm.
I just very worried about what this end game is going to look like. When Chuck Prince said, keep on dancing until the music stops. And
Yes.
that was in the summer of '07. The music stopped in October of '07. The music always stops. But what has me really unnerved, okay? What has me really unnerved is that if you say to me, hey, Rosenberg, you've been wrong for 2 years, time to get in the market, catch the religion. But here's my big fear is that once you go in to the US market, when it's time to go out, when you think you can time the peak,
Yes.
there'll be no buyers on the other side. There'll
Correct.
be no bid. You will
Correct.
try to get out of a market, the most concentrated, not just concentrated in terms of sectors. Well, they talk about how the market's broadened out a little bit. The earnings haven't broadened out.
Yep.
It's still as concentrated a market as it was back in the late 90s with TMT. Remember, technology, media,
Uh,
telecom. But the concentration on household balance sheets, especially amongst the 80 million pig in a python called the baby boomers, 60% of their mix is in equities.
mhm. Yeah.
And what happens is you develop this comfort level, complacency, and hubris because you've been right for the past couple of years without fully understanding economic and financial history. Nothing lasts forever. But the risk this time around, the risk this is bigger than we had in the dot coms, much bigger. The concentration of household balance sheets is much bigger. What happens when there is no bid, when there's a stampede to the exits? And I don't know if that's next year's story, and I don't know if it's a 2026 story, but I know that's going to be a story I
Mhm.
don't want to participate in.
Yeah. Well, there's an old phrase too, my friend. Wealthy investors want to be wealthy once, not twice. So taking them through, our industry on the wealth management side, I never ceases to amaze me when you go through major bear markets and professional advisors are saying to the tune of, well, okay, markets are down 50 and we're down 48. Wealthy investor does not want to be down 48%, like even if they're beating the overall market. And so, the indicators you're pointing to, David, I would actually wholeheartedly agree with you in that you got significant insider selling right now. You've got the US market making up the overall global markets of around 73%. Kind of reminds me that when Japan hit the peak, their peak in 89, on an ACWI basis or a global index basis, they were the largest by far at that point. Just when something becomes so popular, this phrase, I think Google, one of its favorite phrases after Trump got elected in was along the lines of US exceptionalism. Un- Unfortunately, that just speaks to too much confidence, I think, in the markets, and that you tend not to get paid very well when things are extremely confident. So, flipping the screws here, how do you feel about Canada, the Canadian market there?
Well, you have more downside protection in Canada because the valuations
Or cheaper?
are so much more compelling. But that's, of course, partly a product of the fact that it's more a value index than a growth index, and the S&P is more a growth index than a value index.
Yes.
So Canada is more of a value trade, but it does, even when you adjust for the sector representation, Canada trades cheaply. You have more downside protection. um, I think that, the problem for Canada is being a small open economy, is that the global economy cools off. That's going to have a detrimental impact on corporate earnings, considering Canada is so export dependent.
Yep.
Um, I think that that's going to be a problem. China is still working through its balance sheet recession. There'll be more stimulus, but look at all the stimulus that Japan did in the 1990s. It's no easy task to crawl out of a balance sheet recession. Look what happened to the U.S. In the Great Recession. It takes a lot of time. China will not be a factor. Japan is roughly flat, growing marginally. Europe is in a mess. France is in a huge fiscal mess. Germany is heading back into a recession. And when you look at the United States, everybody talks about, well, this is a 3% growth economy. To which I say, no, it was. It was. I got the monthly GDP numbers in the United States, and year over year, it's 3%. Upon closer inspection on a 6-month basis, the GDP trend is down to 2.3% at an annual rate. And on a 3-month basis, it's down to 0.7. So what it's telling you is that the momentum in the United States is clearly subsiding. And Canada, after all, is a torque on global GDP.
Yeah.
On top of that, there's still a wall of mortgage refinancing coming our way in Canada.
Yep.
The bank is started to cut rates too late. They're making up for lost time. There's more to go. I think the Canadian economy is already in a recession. I agree with Stephen Polo's, ahead of the U.S. in a recession, and is in a disinflation slash deflationary environment, in my opinion. So it's difficult. It's difficult in Canada to be bullish beyond the fact that we have compelling valuations. To which I say, well, maybe the valuations are compelling, for appropriate reasons. So, Canada, there's going to be some areas I think you can, point to, who could benefit from lower interest rates. Uh, Obviously, housing related, building materials, the credit sensitive sectors. I think the financials, the banks in Canada should be fine, but they're multinational organizations. But as the yield curve steepens, probably be good news for the Canadian banks. That's not an unimportant call. It's tough for me to be bullish on the commodity plays. I look at gold not as a commodity, but more as a currency, as I said earlier. Commodities without China and without global accelerating growth can be very difficult. So that part of the Canadian market, not so much. The industrials, well, so long as the US doesn't go into a deep recession, the weaker Canadian dollar is going to be a major boon for all those industrial export oriented Canadian companies that'll benefit on the currency translation. So that's as far as I'll go on what I can say bullishly on Canada. Outside of that, I would say the bond market is still going to be your friend. You're not buying the bonds for the yield; you're buying it for the capital appreciation because rates still have more downside potential on both sides of the border.
With a weak Canadian dollar, like where we're at right now, doesn't that put us on sale from a point of view of U.S. companies wanting to buy up, some of our leading companies here?
I'd
I,
say that
yeah.
I would say that so then you want to do a lot of work on who those takeover candidates would be.
Yep.
And But I would say that yeah, that's an M&A wave as a result of that, foreign related,
Possibility.
would be a product of of the weaker Canadian dollar. It's a look, there's it's you know airlines. There's not that many, but airlines that have more of a global exposure, you want to avoid because Canadians not going to be traveling
Yep.
abroad or in the United States. So it opens up, where do you want to invest in Canada as a tourist destination? Americans will want to come to Canada. Maybe Donald Trump will send some people up to do some kick some tires to see how we can become the 51st state. Um, but all kidding aside, uh, and this is less of a stock market play, but maybe just more of a thinking about setting up a business. I would have to think that the tourism business in Canada with the Canadian dollar where it is and where it's headed is going to be a very lucrative business.
So you think potentially Canadian dollar is going to go lower?
I think it's going to go lower. I think the Fed is going to mistakenly and prematurely declare a pause. The bank will continue to cut interest rates nonetheless. They made no bones about that. They're going to carry on a policy that is not contingent on what the Fed does. and the Canadian dollar, and if we're in an output gap with disinflation pressure, homegrown disinflation pressure, the way that you offset that is through a weaker currency. That will be, well, I wouldn't even say inflationary. It'll be an antidote to the homegrown disinflation deflation. A weaker Canadian dollar is a byproduct of that. I mentioned the airlines before. Airlines that have more of their roots within Canada are going to do just fine. So there's different ways you can get even more micro in terms of how to play the Canadian dollar. But the Canadian dollar is in a fundamental bear market.
Gotcha.
And when the conditions change, my view will change. But, we're not there yet.
Okay, everybody, we're going to take a quick break. We'll be right back with David Rosenberg.
Want to know how Canada's top entrepreneurs think about creating significant wealth? Join me, Thane Stenner, founder of Stenner Wealth Partners at CG Wealth Management and host of the Smart Wealth Podcast. Download today at iHeartRadio or your favorite podcast platform. Subscribe now.
After our quick break, we're back here with David Rosenberg. So let's go around the world to the last few questions here. Europe, emerging markets, valuations, opportunities from your point of view.
Yeah, no, well, it's the emerging markets have the most compelling features. We do this monthly strategizer publication. I know you get it.
Yep.
And the emerging markets have been flashing green. And we're telling people, yes, we missed the U.S. rally, but there were segments of, including Japan's not part of that, but uh, there's parts of the markets that we've been quite bullish on. Mexico is actually one of them as an entrepot and a beneficiary from China being in the penalty box. Japan is too. We've liked India, notwithstanding the fact that Modi has less of a political strength that he had previously. Yeah, the emerging market world has a peg ratio far superior to most other places in the world. Has an equity risk premium that you get paid to take on the risk. More compelling valuations. So if I have to be invested in the equity market, that is still a primary focus for us.
Interesting. So the final question for you. Trump's second term going to be better than his first, or is it going to be disappointing in your opinion?
Well, his first term. I mean, notwithstanding the fact that his administration was like a constant turnstile
Yeah.
and chaotic.
Yes.
What's there to complain about Trump's first term? What's there to complain about? There was the world was in a better place.
Yeah.
I don't. Can we attribute that to Trump? I don't know. What do we attribute to Joe Biden? However, the reality isn't in his 4 years. The world was there's none of the hostilities that we have on our hands right now.
Yes.
Stock market did well, really except for, there's a couple of years where the bond market had it rough, but finished off really strong. Despite his tariffs, inflation went down, unemployment, had a three handle by the time he was, well, before COVID anyways. His first term was actually pretty good. When you think about it, nobody's perfect, but his first term was pretty good. I think his second term, he's got more challenges ahead of him. The world's a scarier place. Point number one. Point number two is the debt ratio is like 35 percentage points higher.
Yep.
When he took office in 2016, the deficit ratio was 3% of GDP. Now it's 6%. They said the debt GDP is 35 percentage points higher. And he was coming in back then with very low expectations on the economy. And now everybody's all bulled up on the economy. I think that when taking a look at expectations and sentiment, confidence, those levels were a lot lower than they are today. We were not in a ripping bull market. 2016 was not a ripping bull market when he took over. We're basically flat. And then, this year we're going to be up, around 30%.
Yep.
So the other part is Congress. It's a much more fractious Congress. I know people like to say, well, it was a clean sweep. Yeah, it was a clean sweep. However, the House, he's got a couple of seats of majority in a House that is replete with fiscal conservatives, including 37 of the Freedom Caucus. who aren't going to go along with deficit expansion. And I think that for people that are buying the market, hoping for tax cuts, unlikely. Um, but I think that, I'll tell you that I saw him recently on the uh, Meet the Press interview that he had.
Yes.
And, I was really, I was blown away by his demeanor, professionalism. He was stately.
Yes.
And the way, and there were some really harsh questions. He answered all of them, and you know, I, I I don't think that he's going to embark on a global trade and tariff war. I don't think that's going to happen any more than when she asked him, are you going to go after your adversaries? I'll leave that to the attorney general. Are you going to fire Jay Powell? Well, no. Are you going to get rid of NATO? Well, only if they don't pay their bills. I sort of noticed that a little more getting back to balance.
Yes.
There's things he's going to do: the drill, baby, drill, the deregulation.
Yep.
There will be some tariffs, no doubt about it, to get some of the non-economic ends, like what he's doing with his threats to China, to Mexico, and to Canada. But I think he's got. I think when you benchmark the expectations and what he's going into, I think that he's actually a good. I think that he will surpass them. I think that he's going to do a very good job. I think that the bar was so low heading into 2016. Uh, Now the bar's been set very high, but I do think that he's going to do a good job. I'm not a Trumpy. I'm Canadian. I didn't vote for him, but I would say this much, and I think this is one of the reasons why the stock market, beyond the AI craze and all the belief about no recession is ever going to happen, I think he put together a very solid economics team.
I
Very
agree.
solid economics team. I don't know so much. I mean, other parts on the domestic side, question marks, but his economics team looks really solid. And I'm an economist, I'm a market economist. So I think from that standpoint, from an economic standpoint, I think he's going to do a fine job. But it doesn't mean, by the way, Thane, doesn't mean that he or anybody else is bigger than Mother Nature.
Hmm.
Mother Nature being the business cycle.
Yes.
So do I think, Ronald Reagan presided over a recession, viewed as one of the best presidents of the past century. And I think that it'd be strange if Trump didn't preside over a recession that had already started before he became president.
Yes.
But recessions do end, and I think he will be forgiven. But yeah, I'll give him the benefit of the doubt. If the fact that I'm not super involved in the U.S. stock market has nothing to do with Trump, and if anything, he'd give me more reason to be bullish than bearish. That much I'll say.
Very well said. So I'm going to hand it over to any final comments for our listeners today.
Yeah, I would say what I said before: diversification, not a dirty 15-letter word. That we should all be very concerned that nobody rebalanced this cycle. Nobody took profits, nobody rebalanced, everybody is all in.
Hmm.
So I would say that starting now, I would start to build a liquidity buffer. I would start to build some cash because you're getting paid to be in cash.
Mhm.
And that would be my advice. I know it's very painful because people feel so attached to their stock portfolio, it becomes an emotional decision. It should never, ever get to that point. But I know based on my client feedback that debating the market now is even worse than debating politics or religion. And it should never be like that.
Yes.
It's become personal, which
Mm.
tells me that there's something very funky about this market. So that's what I would say. I'd say you get paid to be in cash. I like the bond market. I would say that, if someone said to me, I've got a barbell of 4.5% T bills and 5.5% Ginnie Mae mortgage bonds, which are guaranteed 5.5%.
Mm.
There's something else where Ginnie Mae bonds are trading right in line with corporate bonds. one has a default risk and one doesn't. But that again is how the markets are behaving right now. That risky assets aren't risky. Just contemplate that. Risky assets are no longer risky. That has me a little nervous. So yeah. So basically, if you don't want to follow David Rosenberg's advice, surely you'd want to follow Warren Buffett, and that's my recommendation.
Yeah, well said. He's 33% cash right now, and I've seen him do that at various times. He tends to be a little bit early too, but when things do get into really challenging, choppy markets, he's always ready to buy more and buy with really good terms. But David, that was an excellent interview. Thank you very much for sharing your time. I'm sure everybody that's going to be listening to this is going to appreciate your words of wisdom. I've known you for quite a while, and I appreciate your candor and your humility too, because this is a tough business to be in. As Warren Buffett's former business partner Charlie Munger said, "Anybody thinks the stock markets are easy, they're stupid." So on that note, let's finish, my friend, and thanks again for your time. Really appreciate it.
Take care. All the best.
All right, you too. Bye-bye for now. That was David Rosenberg, founder and president of Rosenberg Research, an economic and financial market consulting firm which provides advice to almost 3,000 clients from around the world, in fact, 40 countries. This episode will be released on BNN Bloomberg, iHeartRadio, and all your favorite podcasting streaming platforms on January 8th, 2025. So please stay tuned for that. Again, I'm Thane Stenner, and thanks for listening to the Smart Wealth Podcast. Have a great day, everybody.
The comments and opinions expressed in this podcast are the results of work done by Stenner Wealth Partners Plus. They may differ from the opinion of Canaccord Genuity Corp. And should not be considered as representative of Canaccord's beliefs, opinions, or recommendations. All views expressed in this podcast are provided for informational purposes only and do not constitute an offer or solicitation to buy or sell any securities. The statements expressed herein are not intended to provide tax, legal, or financial advice, and under no circumstances should be construed as a solicitation to act as a securities broker or dealer in any jurisdiction. All views are intended for general circulation only and do not have any regard to the specific investment objectives, financial situation, or general needs of any particular person, organization, or institution. Canaccord Genuity Wealth Management is a division of Canaccord Genuity Corp. Member CIPF CIRO.